224, they will be, they'll have more multiple choice, at least 10 to 12, right? So the mock review will help. I kept questions on from the last one I sent you, so you can review those again. And then I'm going to have, I'll just add the ones for the last 3 chapters, okay? So, for the problems part, I'm again going to do like the question type ones. So it's important to review the material. So for example, if you have a situation, what type of errors could you have, not errors, what's the difference for account treatment? If you have accounting principle versus a change in accounting estimate, then you should be able to say, right? So gonna be those type of questions. So for the homework, because I already put up the homework for all 3 chapters, it's focused on those questions. So keep that in mind too. So if you go through those, you're comfortable, you should be comfortable on the final. It's not gonna veer way off from that. It might be combinations of some of those, but basically it's gonna be that same theory base, right?
Question.
Yes,
Okay.
yeah, I have some of the brief questions. The most of anything, it could be the journal entries, but I am thinking it's gonna be more theory based, right? So go ahead and read the chapter, make sure you're comfortable, and then you should be good. So next Saturday, it'll be the final. And I'm gonna put in the group, how many questions and all of that, right? Any questions on that? Concerns? I saw people uploading homework. So today I'm gonna go over all the homeworks. So I could tell you your grade going in. And then we go from there.
We still have an opportunity.
I won't stop.
Okay.
So if you haven't, I could give you up until Wednesday. Right? So up until Wednesday, you could submit. And then I just gonna sit down and go through all. I just want, once I sit down and go through all, that's it. Right? So up till Wednesday, you have to complete your homework. Trying to think if there's anything else. So I think that's the main points. So today we're gonna look at chapter 24. Like I said, I already assigned homework for it. And I am focusing on the theory aspect of it. So chapter 24 deals with disclosure. So in all the chapters you've covered, you've looked at the asset side, right? So the liability is equity. The first part, intermediate 1, focuses on the asset side, right? Intermediate 2, liabilities and equity side of the balance sheet. And as well, now the thing that brings it all together, disclosure, right? So this where we're talking about the notes as well as any other type of disclosure that's required. So one of the things about disclosure, the first point is that our principle in accounting is full disclosure. So that's the principle. Yeah. So that's a key principle, like I said, that's a key tenet of accounting. We want to provide enough information that the reader could make a decision, right? And they're informed. And whatever we disclose have to be significant, and we use the word material, that it could influence that decision. So anything that is material should be in those financial statements. So some things we look at when we think about full disclosure, we have to temper it based on So some key considerations, the first one is cost. We could put a whole lot of information, but it's gonna cost us because it takes a lot of time, a lot of money to put in to include every little detail. So we have to measure what's the cost of full disclosure. We also have to look at information overload. We don't want to give the reader so much information they can't make a decision because it's too much. Right? I think that we are getting there in terms of overload. When I first was doing financial statements, they used to be like 15 pages, and now they're like 70-something pages, right? Because it's so many things people want to see, but you always have to think about where's information overload. The other thing impacting disclosure is there's an increase in requirements. So accounting itself, the Standards Board and other external parties, they're requiring certain things to be disclosed. So you don't even have a choice. And this has definitely increased. And these are linked to things like complexity of the business. So this is something that's required, that you have to tell the reader about the complexity, segment, what other businesses you're in. The next piece is timeliness. So you have more requirements, like if you are publicly traded, you have to report quarterly. So that's more timely than waiting a whole year to get information, and there are deadlines and parameters around when you do what you do. And then the third thing is accounting becoming more a control and monitoring device. So in the past, accounting provided information to make a decision. Now accounting is being used and this financial information as a control and monitoring device. So I can monitor what you're doing through your financial statements. I can tell if you're managing your debt properly, right? And I could actually monitor it by the disclosures, because I could see if there's any gap. You have this amount of deposits, and then you have this amount of loans, and your delinquency rate is X. If you keep going at that rate, you're gonna have a gap and you could have a run, right? So that's monitoring more than I make it information whether I want to invest in you or not, right? So now it's being used as a control. So because of these requirements, right, you see more disclosures happening. The fourth thing, when we think about full disclosure, is differential disclosure. So this is really getting at the fact that, and of course this US, what they consider big gap versus little gap. As well as SEC required versus gap. And I'd add one that they don't have in the textbook, IFRS versus US GAAP. Okay. So this is the other reason you have a lot of disclosure, because if you are in multi-jurisdiction, sometimes you have to show IFRS, say for the consolidated entity, and if you have a US entity, you gotta file, if you have to file in the US, you have to do US GAAP. So some people have to do both standards. This concept, we're gonna get into this a little more, big gap versus little gap. So there are things, depending on size, complexity, scale, you have to disclose versus big versus little gap. So an SEC also has requirements. They have serious requirements. So if you are in the United States and you have them as your regulator, you're gonna have additional disclosures are required, right? Even if GAAP don't require it, they require it. So this is just the backdrop of the disclosure principle. So 4 things we have to consider: cost, information overload, the increase in requirements, and then differential disclosure. So if we go a little deeper now, and we look at full disclosure. So all along we were looking at numbers. We were looking at the income statement, balance sheet, statement of cash flow, statement of retained earnings or equity. And so we were looking at numbers. So full disclosure means that we have to look at quantitative, because that's the numbers. And we have to look at qualitative. Data. All right. So when we think about qualitative and full disclosure, this is where we get into the notes. Okay, so the quantitative, we get a lot of that, and so balance sheet. Okay. So now we talk about the notes. And this brings it to a complete set. A complete set of financial statements is quantitative and qualitative, because you have the numbers and you have the what we call qualitative information that goes beyond just numbers to explain certain concepts. So, like I said, you have for this course, it's intermediate, the first level, and then this is the second level where we go through all of the major categories. So just a summary. So when we have the notes go in a particular order, they're not random. So you have notes of financial statements. You could expect the same things in anyone's statements if I look at them. The first things that normally you will speak on is significant accounting policies. So even if you look at a set that's IFRS, you're gonna have before this a note on the entity. This is Bahamas Institute of Financial Services. They're incorporated on this day, they're licensed in the Bahamas, they have this sort of structure. That's always like the first note, right? Then you have the significant accounting policies. So oftentimes when I want to know about a company, I'll go to that first note, and that should tell me where it's incorporated, jurisdiction, what are their major products, where their location is, how long they've been around, right? But no, that will tell me right off the bat, note 1. So then we get in significant accounting policies. So this is where we talk about what decisions we made around the numbers that we have. So when you think about inventory, you could be doing FIFO or LIFO. Which one you using? So that's where you tell the reader, this is the one that we use. We use LIFO. We used straight line depreciation. We write off our receivables on this basis. Our depreciation rates are this. So the reader has the information, not just the numbers, but how you got to them. What's your policy? So this is more a recap. So when we look at inventory, like I said, and in your textbook, this is chapter 9, right? So you have to state when you have to state the method. And you also have to state the amount. Good morning. Right? Right, so this the method to cost. So this the method used to determine the cost. And then you may have a table, depending on how complex it is, to show how they come to the amounts, right? Because sometimes people have different levels of inventory. You have PP and E, which is plant, property, and equipment. So that's chapter 11 of your textbook, which is the first course. And here we talk about things like valuation is used. So you'll see in a note, the historical cost concept is used. They'll actually say that. If they use fair value, which is allowed for certain assets, fair values method is used for these to value our assets. And for these other ones, we use the historical cost concept. So you look at a set, it will tell you that. It also tells you on the fixed asset, it tells you if there are any pledges or loans or any other commitment against these assets. So if you're using an asset to borrow money, you have to disclose that. So if I have a building and I have an overdraft against it, or I have a loan that I'm using it to finance, I need to disclose that. The other things that are disclosed under plant, property, and equipment, you also have to have a table normally that shows the beginning balance, right? Shows depreciation expense. Shows the classes of assets. So if you have land, if you have building, equipment, vehicles, you have to have a table. You also have to disclose accumulated depreciation. Right? So, and then you have to show the comparative. So that's a prior year. So I'm actually doing this for a client right now. I'm doing a set of statements. So this is what it normally looks like. So you will have land, buildings, the equipment, and then you have a total. Then you have beginning balance. And you'll have the date. So this one, say 1/1/2018. Then you have additions. Then beginning balance 1/1/2019. Then you have additions because it's the 2 years. Right, and then you have this ending balance. So this is the cost side. Right, so this balance that you get here should equal to your financial statement. So what you're giving this reader is you giving them a breakdown of your asset value. So any additions, and you'll have another line, disposals, because you could have ones that got disposed of. Right, so they could see 2 years worth, all right? So you also do this table for accumulated depreciation. Your beginning balance. And here you will have depreciation expense. So you have to show that, right, in a table. And after you show that, right, then you will have a line at the bottom that says net book value 1/1, these are 2018, and 1/1/2019. Okay, for each class in the total. And the total has to agree to your financial statements. The total depreciation expense have to agree to your financial statement. Right. So all of that you're doing around plant, property, and equipment. Okay, so when I look at a note, if they had fixed assets, and well, what do they have? I could go to that note and I could see, and that'll tell me some things like, do they own their building? If I don't see building on land, then they probably leasing it because they're not showing any assets like that. And you have companies that are like that, where you are assuming that they own their business. And then when you look at the statement, you're like, wow, they don't own it. Or it could be the opposite, where you're like, they have vehicles too? How come there's a bank? How come they own all these vehicles, right? So they are things that information, like it says, qualitative. You have a little quantitative information there, but is qualitative as well to tell you a little more, and some deeper things like policy, valuation, commitments. They're not necessarily numbers. A pledge don't say that we holding that you actually borrow 50,000. It might just be, in the case of default, we're gonna take the land, right? So it ain't, you don't know what the balance is. Well, you could look somewhere else and find out the balance on the mortgage was not telling you it, that information yet, just that there is a commitment. So if you wanted to invest, know that something coming along with it, right? You have to release that. So the other area, creditor claims. Okay, so this is chapter 14. So creditor claims. So this is long-term borrowing. So here we may get into time. Right. Future cash requirement. So you have to stat how much more cash you need to put out to in the future to extinguish it. And so time being the dates as well. If you have a sinking fund to protect you, right? Because you could put money aside for long-term debts. Not for the full amount, but you could have a fund going on at the same time. The next thing you would want to disclose is equity claims. On this chapter 15 and 16. Right? So this should be your equity. So this is what is authorized, issued, and outstanding. So in some financial statements, you don't put it on the face, you put it in a note, right? Because there may be multiple classes of equity, right? So you may have common stock, you have different levels of preferred A, B, C, D, E. You're not all gonna put all that on the face. You're just gonna have common stock, you can have preferred shares. And then you go to the note to see the whole list. So that's what it'll tell you. Also, if there are any stock options, convertible securities. So remember we did those dilutive. And any restrictions on earnings. So sometimes even the regulator might say you can't pay a dividend right now until you get your capital up to a certain amount. So Bank of the Bahamas was in this position a number of years ago where they had to, I wouldn't say got bailed out, they got a monitor put in their institution because of significant bad loans, and they weren't allowed to pay a dividend, right? Until they got everything cleaned up. So you could have those type of restrictions where even if you want to pay a cash dividend, you can't, but you have to disclose that, right? So then we have contingencies and commitments. So this is chapter 7, 9, and 13. All right. So any litigation. Right, that's material to what you to your company that you might be involved in. Definitely, if you potentially you could lose, right? So again, here this might not be any numbers. What we try to do is ask when audit is happening. Oftentimes you have this thing called a legal confirmation, and you ask the lawyer, could you confirm what's the possibility of loss? Some of them will say, may give you a percentage, some may don't say anything because they don't want to say that, because if the other side sees your financial statements, they'll say, oh, well, they think they're gonna lose, right? So you put wording around here so the reader understands there might be a lawsuit sitting out there. In the US, it's a big deal because I just saw one of the companies that do those vaping cigarettes. They lost a big case and it's over $1 billion. They got to pay out, right? So these could be big, right? When Exxon had the oil spill, that was a lawsuit. So where they had to spend billions of dollars cleaning up other environmental things they needed to do. That could destroy your business, right? So litigation is something you always want to include. So this contingencies and commitments. So it may also be commitments for dividends. So you may have restrictions there on dividend payments. You may have purchase agreements. Hedge contracts. Even employment contracts that may have some significant of course, all these have to be significant if you disclose it. So if you have a CEO that if they leave, that you gotta pay $1 million or whatever it is, right? That might be significant enough to disclose, because no matter what, if this person does horribly or they do well, you gotta pay this money out, okay? So those things are important to know. It doesn't mean you paid it out, but the reader is aware that they're sitting out there. The next item for disclosure fair values. So this is chapter 17, right? So you can have many things valued at fair value, and you should state it. So you should be stating here assets and liabilities where fair value is applied. Right? Because what that's going to do is help the reader understand what part of your balance sheet is based on historical costs, the cost when you say it's a fixed asset, the cost that you purchased it, and which items are valued on a fair value, so that's the market price. So you'll have entities, because you're allowed to use fair value, will revalue land and revalue buildings because they could bump up their balance sheet, but it's important to let the reader know that you switched from historical costs to fair value. Because fair value requires you to do some things. So if I chose fair value to value a building, then every 3 years, I think the stipulation is you have to get a valuation done. So you don't just do it once and okay, I didn't know. Once you switch, you got to stick with it, but you got to let the reader know. So when they're looking at it, they're like, how come this number keep changing? How come you all keep increasing it? Because what it does is increase your equity in your value, right? And this could be a danger zone as well, because if I sit in somewhere and I say, well, I'm going to get a couple valuers to come and value, this will bump up my equity, my value, my company will be way more, especially if I'm trying to sell it. And then the market crash on real estate, you lost because you can't even sell it for that, right? So that's why the stipulation is you do it on a frequent basis every 3 years, just in the case your market declines. Because if it declines now, you got to take the loss, right? Next one we have deferred taxes, pension, and leases. So this is what you covered in this course. So that was chapter 19, 20, and 21, right? So here, you covered this already. So we're looking at things like future financing needs, where it applies. We also looking at commitments related to these, right? And here the disclosures are very extensive. So where you have pension, you gotta say what type of pension plan. So if you look at disclosures around this, just this one, this could be 2 or 3 pages, depending on if you have defined contribution versus defined benefit. If you have a defined benefit, there'll be an actuary statement along with your financials. You have to do a valuation. You have to say when the valuation was done. You have to say how many people were in it, how many people left, all that thing you did around pensions. You got to show that. Lisa, same thing. You have to say how many operating leases you have, right? And then how many financing leases you have. What's the time limit? What are any commitments under the lease? And then deferred tax, of course, right? What that value is, the period it's being amortized, or any prior service cost, like anything to do with deferred taxes, tax rate. You have to include that as well. And then lastly here, changes in accounting principle. All right, and that's the chapter we did in this last trio, so this chapter 22. So you gotta list every change that you did and the impact. And if you, when you look at disclosures, sometimes you have to put a table to say, if this was the number before, we had to restate, this is the change, this is the number after restated, because when you have changes, they could be ones that are done retroactively, and you restate all the numbers before. It could be current, it could be prospective. So you have to make sure the reader knows what's happening, right? So all of that is qualitative. So this is just one piece of the notes. So you could already tell just from this, you could have pages. So that's the significant accounting policies. The next thing that is important to have in the notes to the financial statements is where we need to disclose special transactions and events. Okay. And the thing that we'll have here more than anything else is related party. So what is related party? That's where the person we're doing business with, we related to them in some way. Maybe they may be what I call the mother, the head office, right? Maybe they may be a family member, because I own food store, you own the retail outlet over there, we related, right? So it could be related in terms relational, it could be related into corporate structure, you own shares in me, or I own shares in you. So we related, right? If it's significant. So we normally think about these transactions, or we want them to disclose, because normally they are not at arm's length. Or what we call our free market. What do we mean by that? That means that I make a decision as a company, we buying all that stuff from Bahamas Food Services. I'm not getting quotes. That's not free market. If I'm over here somewhere else, I can't even bid on it because you've gone to BFS. and you decide, I am only dealing with them, right? That's not free market. Free market, all of us could bid, all of us could participate. But when it's not arm's length, that ain't happening. That's not a question. So here, sometimes, depending on the industry, the regulator might be here, right? And that's why this needs to be disclosed, so the reader even could be clear. Sometimes you're gonna have a different price because of this, right? It could be better or it could be worse because of this. So I might be using a lot of paper, and the bank charging me a lot of fees for paper, but it might be because one of the board members owns a paper company, and we only buying from them. We haven't even getting quotes. We don't even want to automate it because we want them to have it, right? So that's where you have to think about the reader, then thinks about, do they really have efficiency? Is this a good thing? But at least you are aware, right? So you've got to disclose some things here for sure. You have to disclose the nature of the relationship. Right? You have to describe the transaction. And you have to state the dollar amounts involved. So for audit persons, we always give them a questionnaire and we say, advise us if you have any related party transactions, and they're supposed to self-disclose. Sometimes they don't self-disclose and you figure it out, and that ain't good. I don't like when that happens, because that means if you're dishonest once, you can be dishonest again. But this is forced because when you look at all those Enron situations, some things happen because the owner son was in the business. You had all kind of what I call incest. And people do things when it's family. So I found out the other day, I didn't know this, well, I shouldn't say the other day, I knew from, heard about it, that a certain bank was renting space, and the person who they were renting it from was a senior member in the bank. And that's little, and I know that wasn't disclosed, right? And I would want to know, were the same terms used, the square footage you paying, is that what's the going rate, right? So that's why when you think about disclosure, why there's such a big deal in our country around the Public Disclosure Act, because that's what they're saying. If the government doing business on our behalf, they should disclose it, right? Especially if it's not arm's length, especially if this. So we want to make sure this ain't your friend. And if it's your friend, you should be able to say the nature, describe what the transaction is, and tell us the dollar amount involved. Right? So that's why we have in financial statements, because all those scandals, Enron, WorldCom, every last one, to me, come down to this is a big chunk of it. Not the only thing, but a big chunk. They set up a shell company somewhere else, they're doing business with them. You don't know who behind the shell company, but it's really one of these people, and they doing this. And they charging a different rate, and they doing some things, and they're able to take money out of the company, right? So sometimes as auditors, we have to dig deeper to figure out who this person is, especially if they're a significant vendor, to make sure they're not that. But we always ask people to self-disclose, and this should be in a financial statement, right? So that covers the disclosing special transactions or events. So next we have post-balance sheet events that have to be disclosed. And we have our word in accounting for it, we call the subsequent event. That's not what we put on the statements, it's normally post-balance sheet events, but it's really subsequent event. So there's a gap between when you actually, so I have my year end, December 31. My financial statements might not be signed off until March 31st. So I have 3 months. Something could happen before I sign. And that period, we talk about post-balance sheet. So anything that happening during that period, we need to make sure that nothing significant happens that we need to disclose. All right. So if I define this between the year and date and sign on. What's that period? So it could be an event that might require adjustment. Or it could be something that provides evidence about conditions that change since balance sheet date. So let's see what some of these could be. Just so you have an example. So starting with B, evidence conditions change. So I had a December year end, and then my sign off is March 31, but March 15, we had a lockdown. I sign it. I get a subsequent event, COVID. I don't know what can happen. It could destroy your business, especially if you're a restaurant. Right? So you want to disclose that. Right? So that's an event that could occur that could change the conditions. You could have at the balance sheet date, this, you have your numbers, your sign off is March 31, and say we're a bank and central bank decide that nobody could do mortgages for 6 months. And they announced that February. That could change this. And you need to disclose, because if I'm the reader and you tell me the most growing part of your book where you make all your money is mortgage, and all of a sudden central bank say that, I will know that. I will know what impact, because that's really what we say on right. What is the impact on your balance sheet? This one requires adjustment. So say between December and March, you had a lawsuit out there, right? And say we couldn't book it at December because we didn't have enough information to quantify what the amount is. But something happened with that matter, whereas you settle, or maybe you got a judgment and they say you have to pay $1 million and you didn't know that before. You thought always going to pay 50,000. You got to adjust your numbers to $1 million because you have a number and you know it now and we ain't signed it yet. So that's why it's so important to sign quick so that you don't have this huge gap. So some firms, they do a whole bunch of another set of procedures. As long as that time going ticking, and you taking long to sign, they doing a whole bunch of procedures to make sure they don't have none of this, right? Because then they can bear some of the risk because they should have tested for it. So this could be very important. When COVID happened, after, because now not everybody have December, some people had like August or June or September. I think like Bank would say year end is June. You had people who had year ends like August. some insurance companies, so by then we were really locked down. All of them had to have a COVID note. So that COVID note dealt with this the impact of COVID, would it impact this business, depending on how the business is? Would there be any loss of revenue? So definitely if you're in the restaurant space, for sure, hotel space, for sure, airline business, for sure, transportation, yes, you're gonna be hit hard. Maybe not for some services that you could do online, anything that could move online might not be that hard. Schools, for sure, right? So you going on the list because now you have COVID. How did that impact your numbers? Because these people made projections. Oh, we're gonna do this. We're gonna sell all these cars. Ain't nobody driving, right? So you have to think all these things through. The hospital and pharmaceutical made record profit, right? So you have all of that. You may have more death claims if you're in insurance. So you have to think about that too, right? So all these things, post balance sheet events, these become very important to the reader. If they're known and you haven't signed off yet, you have to allow for them. So the next thing we're gonna cover so we covered the post balance sheet. So the next piece we have to disclose is 5 is disclosure of conglomerate companies. Conglomerate diversified companies. So here, right, so conglomerate companies are companies that have multi-lines of business. They may be across countries. They may, so say LMNV is a large conglomerate. They own Louis Vuitton, they own Coach, Louis Vuitton, Coach, and I can't remember the other bag brand. And then they have more, they have these big shopping areas in Europe. Okay, so that's a conglomerate level. They multi-lines, it could be multi-locations. You have companies that, like, say Honda has cars, motorbikes, machinery. I think Honda even getting into planes now, or certain type of stuff. Then now you have electric vehicles. Each of those different. You have companies that produce in the commercial space and retail space, right? So again, diversified. You have, in our local space, you have like a John Bull. John Bull has their main retail business, perfumes and bags and all of that, which has lines of products underneath it, but they also have Starbucks, Subway, right? So they other lines that they have sitting out there that all come into the John Bull group. So this segment's data, companies that are set up like this have to, there's a level of disclosure that's required, and we call it segment data, because you say in your data what piece of the business is in each of these segments. So say if you go by products, and I'm an insurance company, then I'll tell you how much is life, how much is health, how much is annuities, right? If I'm in the hospital space, I may say how much is patient care, how much is pharmacy, how much is, if they do telemedicine services, ambulatory care, because that's a whole line of business they may have as a line of business, right? So whatever the business is, you're gonna have different, and that's useful to the reader, because then they could see where your income coming from. Some companies, you'll be surprised, their main line of business might be banking. A lot of banks here, they'll have their banking products, but they also have insurance. Because they sell insurance to go with the banking product. And you may be surprised, sometimes the insurance product making more than the banking product. Right? So that's why it's important to see where you really getting your money from. I was talking to someone when Bank of Bahamas had their HEM, I went to it. And they got a lot of money from recoveries, right? So it's good to have that segment information, because what happened to your regular business? That's old business. So what happened to the regular business? Y'all booking loans? Y'all automated as you should? Like, so you get into those conversations, because now you could see where because on the income statement, just have revenue. Right? So that's why this is very critical. So there are pros and cons to providing this. So some of the pros, and these some of the cons, because there's some people who don't like providing it. So some of the reasons against, it's because of complexity. Some people don't think it's complex. It could mislead an investor. They feel it's could cause competitive harm. They could cause adverse impact to internal decisions. And they think it's limited in terms of usefulness. This more because you can't compare to anything else. Okay. Also, the investor is not concerned. So the investor concern with overall, not segment. And then the last thing they suggest, it's difficult to allocate some costs. So I put here common costs. All right. So this people who don't think it's good to disclose it, this is a big deal, common costs, because if all of us using, say, administration, all of us using HR, how much do I give this segment, those amounts, their share of it? Because when I say in whether that segment is profitable or not in this segment data, they also share in the cost. Now, big companies have formulas for saying if you use HR, this is the rate we're gonna charge each segment because this is the going rate on the market. If they have formulas to do it, but still it might not be precise enough to say what is used. So HR is a good example because that's a common cost everyone may have. Administration, things like legal, those type of admin costs are hard to allocate, depending on how you're structured. Investor, they're saying investor don't care about these segments, they care about the overall. Overall, you making money or not? Are you doing what you should or not? They said limited in terms of usefulness because comparability issue. So if I have LMNV, which owns all those brands, who do I compare them to? You show me segment data, but what do I compare that to say, okay, this is reasonable or this is unreasonable? It may make sense for your entity, the way it's segmented. Adverse impact on internal decisions. So sometimes if that's provided or they focus on segment data, it may drive some people in some departments to say, well, you're not useful because you ain't making as much as this brand over here. That might not be the objective, right? In some companies, if I buy, I remember doing a case study. I was doing a course and it was a case study on LMNV. And I don't know why I can't remember the third brand. So they had Coach, Louis Vuitton, and they had another brand, right? And their strategy was that the persons who have, it was a brand underneath Coach. So the persons who were at the lowest level in brand was that brand, say it was Jones, New York. I'll just pick one, Jones, New York. They looked at them as the ones who just wanted a nice buy. Coach, they said, was the aspiring customer. And then Louis Vuitton. So the aspiring or aspirational, they have money, but they can't reach Louis Vuitton yet. And Louis Vuitton is the ultra high net worth customer that you come, if they on a boat, you go there and you give them their bag. Now their strategy was that you in their chain. So they pushing you to the top one, and they recognize that at the bottom, they can have high volume sales, Whereas at the top, they have sales, not high volume, but the price point is much higher. So if you look at segment information, you may say, well, you're only doing a lot of sales, right? And that might not be what it is what is their overall strategy, right? And why does it work? And you have stores like that, Walmart, you go to the counter, they have a markup of 500% on everything sitting at the counter that you could buy, but they have the sales in the back, so you have to walk to the back to get to the sale. That's why, I don't know if you ever noticed in stores where you have clearance in the back. So you gotta walk past everything to get to it. And you see everything, oh, I like that, I like that, I like that. And you get, so that might be totally discounted, but everything you pass in is marked up to cover that, right? So again, segment could be harmful, right? Because you may have an overall strategy, it's actually working. And then complexity, so that speaks again to complexity. So they're legitimate things, they're not like, they just blowing it off, but it's, they are legitimate. So the reasons why you want to have it, is needed for intelligent decisions. Okay. And then we say it completes. So complete disclosure by all firms creates better competition. So the overarching thing here, you want to make intelligent decision-making decisions if you're an investor, and you want all disclosure there for better competitive environment, right? If I am a small person and the users of financial information are vendors, competitors, all these people use your information. So if I'm in the market, if I don't know you doing all this over here, the segments and stuff, and I'm competing against you from the point of view, oh, you're only doing insurance. Sorry, you're only doing banking. I don't want the full picture, right? I may also say as an investor, well, if you only have banking as a product and I can't see really your segments and how you really working all these different products together, then I might be like, I won't go to a company over there that have all of that. That's a complete package. So when they come to the customer, when they deal with a customer, what I would say they have a bundled product. Our customer don't go nowhere else. They could get their mortgage, they could get their car loan, and they could get the insurance to cover those things. So they one-stop shop. Whereas you only look like you're doing banking, right? That don't make sense. That ain't the way everyone else doing it. So sometimes it's important if you really want to give your investor full information to choose you, right? To have that information available. Because really, at the end of the day, what we want, or what we're trying to achieve, is we want to make sure we have better understanding. Okay, of performance. We want to be able to assess future cash flows. And we want to be able to make more informed judgment. All right, so at the end of the day, we really want to understand, better understanding of performance, better assess future cash flows, and then you just want more informed decision making. So how do we actually do this segment thing? So we know we have to do some segment reporting. Whether we want to or not, we got to disclose some segment stuff. And how do we get this done for our financial statements? We can clean this up a little bit. Sorry. So your textbook, how to say, process where you or approach to dealing with segment information. And we're gonna go through that. I don't know if that's any better. So one of the first things we have to do is identify a segment. So we're gonna do the segment reporting, so we need to identify a segment. So to do that, we need to understand activities that we get revenues from and what expenses are related to that. And we need to have that information from our internal systems, got to be able to generate it. So what companies do often, they code their trial balance based on segments. So they'll have, just like branches. If you have a bank, you have branches, they'll have branch 1 number is 21. This branch is 22, right? And that's coded everywhere, even when you do your banking, your savings account coded to that branch. So all expenses, revenue, so they can measure it through their system. So it's not like, okay, we got to figure it out. It's being generated automatically. So we identify the segment and how we are going to monitor all the information based on the segment. So you have to look at where you get revenue. And then we aggregate these segments. So a segment that you aggregate must have certain characteristics that are similar, right? So it could be based on products or services that are provided, right? So you have a mortgage center, you have consumer banking, you have commercial banking, right? So they buy products, right? Or it could be by services. So you have the walk-in clinic, you have female surgical, they buy the service. You know, maternity, that's by service. You could also have it by production process. So if I'm a car manufacturer, or I do some sort of manufacturing, I may have it by particular area of production. So this assembly line, this is where they receive raw materials. Like I could break it down by each part of that item by production. I could segment it by type or class of customer. Okay, so if I'm Bloomingdale's, I could have my walk-in, right? I could have my appointment customer. I could have the customers I visit, right? Who have their personal shop and they don't come in the store, right? And I could have online, right? So all those are different types of class of customer. You could have by product or service distribution. So again, if I'm Domino's, I have the customers that come and sit down, and then I have the customers I deliver, and then I have customers that pick up, right? So one picking up, one deliver, one sit down that I serve. And then you could have regulatory by regulatory environment. Spell that one. Right. All right. So this could be like you in the Bahamas, where there's no tax, you in the US, you in the UK, you in Canada, everyone have a different regulator and tax regime. If we put it to the Bahamas, you could have an entity like Polina. They have a company that's insurance and insurance commission. They used to have Ansbacher, so that was under Central Bank. And then they had the securities for their brokerage firm that's under Securities Commission as well, right? So Securities Commission, Insurance Commission, and Central Bank, 3 regulators. So you could have it divided by that. So how do we test to see if we have a segment? So there's actually a test for significance. Because you don't want to show every single thing. You want to make sure the significant component. So if you want to determine if that segment is significant for disclosure, you must satisfy at least one of these. So at least one of these requirements. Okay. So the first one is revenue is 10% or more of the combined revenue of all segments. So basically it's 10% revenue of the total revenue, right? The second one, the absolute amount of profit and loss is 10% or more of the greater and absolute of combined operating profit combined operating loss, whichever one you have. Okay. And then the third one is its identifiable assets. At 10% or more of combined assets of all segments. So here, might still say it's the 10% rule. So one of these 10% of revenue, 10% of the total operating profit, operating loss, 10% of identifiable assets. And identifiable assets are the ones you could touch. Right? So I know the land there, I know the building there. We're not talking about intangibles, we're not talking about copyright. We're talking about the ones you could touch and you could see. You could easily identify them. Right? So, so when we look at the type, right? So we can make a segment based on one of these to be significant. Any one of those have to meet one of these criteria, right? So don't necessarily have to be based on revenue or profit. It could be based on asset. So that means you could be a segment that don't really generate a whole lot of revenue, but you have significant assets. Right? So this is important test. Make sure you know that, right? So some other information to keep in mind for segments is that the maximum you could disclose should be 10. Right? You can't exceed 10 segments to report, so you can't have 20 segments or 30 segments. You can't be more than 10, right? And there's the last rule overall. Right, is that when you do disclose the segmented results and you do this test of significance, the results, segmented results, must equal or exceed 75% of the combined sales. To unaffiliated customers. So all this is in your text, but I just highlighted it here. This is a test you have to do. So even though you get past this point, you get past here, you got to make sure the total segmented results are the equals or exceed 75% of the combined sales. So that's a lot of data you collected. So definitely anyone that does segmented information, they got to meet some standards in terms of what they need to report. So we got to the point here where we talked about segment information, what's required, what the tests are, right? And the last piece is actually, we know, oh, it's gone from the next level. So we know what is required. So now, because we just tested to see what is required, now what do we actually report? That's the last piece of the puzzle. Let's bring it on now. So FASB actually has standards around this. What we include here and what should be reported. And that'll be the last piece that I will talk about on segmented information. It's just messy with it. Okay. So the last piece on this, so for the segments, FASB requires. So that whole process we did before was to say, do we have segments first? What are they? Can we identify any areas that we can report? Then we say, do we meet the test of significance? We go through that process. Then we say we can have more than 10. And then lastly, we say it can't, in total, cannot be, it has to be at least 75% or more of our revenue, sales revenue. So then when we get to the actual section in the notes where we disclose segments, we want to report revenues from transactions with external customers. We want revenues from transactions with operating segments. We want to report interest and expense. Interest, revenue and expense. And we want to report depreciation, depletion, amortization expense. Okay. We also want to report general information about the segment information reporting. So you give the reader's introduction, these are segments, this is what we report, and then you get them some of these numbers. So they have it as well. Also, there you include unusual and infrequent items. Equity in the net income. So you have equity investment and then income tax, expense or benefit. And then lastly, any significant non-cash items. Okay. So this is what it requires us to include. We should make sure that we make a note as well about major customers. And this is where we have any of them where we have revenues of 10% or more. Per customer, right? So we want to know who the big customers are because you could have one or two customers driving a segment. So this goes back to what your product service. If this is based on assets, then you also add the asset information. But like I said, make sure you go to your text. I just summarized the key ones here. These are the big items that you would normally include for segment information. The last two things I want to highlight today is, so in addition to segment, you could have interim reporting. And interim reporting is when you report, say quarterly, so basics, some companies issue quarterly statements. They are unaudited. And they provide certain information. In the US, when you provide this, especially on the stock exchange, they have certain required minimums. Your text goes into what the required minimums are. Minimum disclosures. And here you also have GAAP requirements. I'm not going to list all of them out, but you have, I'll just say, you have GAAP requirements here as well for interim reporting, so that there's guidance around that to protect the reader. So someone can just put something there and then at the year end they relied on it, and then at the year end they're like, what happened? Because the interim was saying this, so there is guidance there as well for the reader. So we do all of that. So they all are notes. We have some other things that you could disclose in the notes, like earnings per share information. If you have a seasonal business, you could disclose a note on some information about that. But as you could tell, there's a lot of things that go into that qualitative part into the notes, right? So one of the biggest pieces is the opinion. So we ain't talking about the opinion yet. So you have a set of financial statements. They get audited because that's the opinion is coming from the auditors. So there's an auditor's report, right? And the report normally says these financial statements that are prepared on this basis, if it's IFRS, US GAAP, whatever it is, we determine that these are fairly stated in all material respects. So that's if you have, everything is fine. So we have, and that report also tells you whether you regard the disclosures as adequate, and then you express an opinion at the end, right? In the past, that opinion used to be this small, and now it's like 2 pages, right? Because there's some things that were added and beefed up to it. So we normally have some, my last bit of writing on here. I think the question might put down. So there are 4 types of opinion you could have. So one is what we say unqualified. And that's the opinion you want to get, right? And we call that the clean one. So you don't want nothing else other than unqualified, but sometimes it happens. Let me talk about it. So opinions. So like I said, you have the unqualified. Qualified. Adverse. And then 4 disclaim. So data 4 that we have, you could have this one, unqualified, and you may still need what we call an explanatory paragraph. All right, so you may have an explanatory paragraph in your report if there's something you want to bring to the attention of the reader, right? That happened, you don't think it changes them having a clean opinion, but you want to bring it to the reader's attention, right? So they don't have to go look and figure it out, right? But it's not going to change your opinion. But where you have these, right? This could happen, and what we call is the scope limitation. Right? And this might be, or it could be affected by conditions or restriction. You could also have, they do not conform to the standards. So standards, gap, IFRS, whatever standard that you were using, it doesn't conform to them. Not fairly presented. So the information is not fairly presented. Or you could have inadequate closure. Okay. So scope limitation, what does that mean? That means that I went to do an audit and someone told me you can't look at this part. Right? And people do that. You could test everything else, but you can't look at this part of the business. So we call it scope limitation. And if you do that to us, then you may get one of these, right? It might be conditions or restrictions. So I'm auditing you, but you may tell me that, and you may not even do it. So for example, I may audit you and one of your major locations is in South America and I can't travel there. So I can't test it, right? That might be a big restriction because you're telling me you have this amount of inventory there. They make your, say it's China one of them places. They make in the clothing you selling in all your stores. But I can't go to China because it might be a restriction for me traveling there or verifying. I might could see it on camera or something, but it's not the same if I'm on the location because I want to actually do a count. I'll make sure you say this, you have an inventory, you say you have these land and buildings. It's very difficult for me to verify because of restrictions. So it could be in here, right? I was at an institution, private bank. And so under private bank, you may have entities that get managed and need audited statements. And I remember we got one of these and they were okay with it because the qualification was that we couldn't verify. We told external auditors who were doing the review, they couldn't go to the country to verify because of this. And they were like, well, they use what they have, but they noted it and then they said they have to qualify the opinion, right? So there are reasons, doesn't mean someone commits fraud, it just might be a restriction. This one, don't conform to standard. So someone give me a set and say, I've been doing my books on a cash basis, on no basis, then this can be here, right? This could happen if someone also had someone sitting in the chair, they don't know even what the standards are, they've been doing stuff all year. You may get this. I can't even make an opinion on that, right? I have a situation now with a client where they had a fraud review done and determined over 100,000 probably was stolen. They didn't even know there's probably more than that. And I am helping them so they could get maybe here, but if I just looked it up, I couldn't even look at the fraud report because they weren't even circulating there too, Shane. So if we do nothing, they can be here, right? But I'm trying to get them to at least here or here, right? To even get a set. So that's where that could happen too. Not fairly stated. So if you did some things and in your books, and we don't think it's fair representation, then we could be here. And then just inadequate disclosure. So if you leave things out of the material, then it's not adequate in terms of what you did, then you could be in any one of these buckets. It just depends on severity. So it does happen, people do get those opinions. So the things that cause this paragraph, right, when we have it, it may be going concern. It may be lack of consistency. Or it may be emphasis of a matter. So you want to highlight a particular matter and put emphasis on it. So we put it in a paragraph. Going concern is saying, I don't, you know, these statements are fairly represented, but there might be a situation that we are concerned that this business is even viable in the future, right? They have to say that. So, for example, when COVID happened, a lot of people were here to say, do we need to have a paragraph like that? A lot of businesses went out of business because if you have a restaurant, this could be an issue if you have a lot of debts, right? And your cash flow is very tight, then you might be here. Or if you had a lot of inventory on a boat coming here, you already kind of stuck with inventory, you can't sell. And you holding stuff in inventory for over a year, that might not even be, remember now, Christmas didn't happen, all them things didn't happen. So that could be here for a lot of companies, right? So this will be in a paragraph. So it's not saying that what you presented was inaccurate. It's just saying in the future, do you have viability? We have concerns because of our understanding your business. Consistency, if we notice that you aren't applying things consistently across the board, LIFO to LIFO, FIFO, you switch, like you just inconsistent, then that needs to be highlighted. But it doesn't mean that what you did was unfair in all material respects. And again, these are other pieces. So the textbook talks a little about MD&A. So MD&A is a section in your annual report that we call management discussion and analysis. So any publicly traded company, you would say MD&A. Normally that's provided by the CFO, and the CFO has a little chart in the annual report and has statistics and ratios and talks about how they performed over the year and gives the reader some additional information, what I call from the inside, how they thinking, what their goals are for the future. They may have some forecasts around that. In the US, they trying to have guidance around this. The SEC is trying to develop guidance. So they talk about that in the textbook. But here, some of the focus areas are things like liquidity. So you know, that's why I say it'll always have ratios, capital resources. And then the results of the operations. So they'll be like the major themes, right? So this is your whole set of financial statements and your annual report, what I call your annual report package. So my last job, when I had to review what was provided, I wasn't a preparer, but I had to review it as an independent reviewer. And I remember, because this was come up buying this is like 70-something pages. So this is a big thing to do, right, on an annual basis. So when we started this chapter, the first thing we said is cost. So it ain't cheap. You have to have someone really qualified sitting in the chair to make sure you could do this, right? They also talk a little about in your text, and I'm not going to go through this in detail, about financial forecasting. People do that to help the reader with where they're going in the future. So in the US, it's a big deal. You had them say Apple had a call on the market, and they had they were talking about the interim results and their forecast for the future. They come out with a new phone, and that gives investors insight as to where they're going, the direction. We're gonna expand so many locations. We're gonna discontinue this thing. So that gets into all that conversation into the future. So your text talks about it a little, and so that's something, just read, make sure you're aware of any issues around that. So that's the end of chapter 24, the end of your course, right? So next week, like I said, you have a final exam. And so again, just as a reminder, be multiple choice and 3 questions. I'm going to take a question from the first part, right, that you had before. But like, again, I said, I'm going to focus on the theory piece of it. So just make sure you go through the questions, you understand the material, and you should be good to go. I'll also send a link for the review, right? So I'll do that by Monday, probably do it today while I'm sitting down reviewing stuff. So are there any other questions, concerns? Yeah. Y'all interested in being accountants after this? I tell people I don't charge enough money. I think we are we get paid the least out of the lawyer, doctor, engineer, architect conversation. We need to charge more, but they even want to manage how much we get paid, so to make sure we independent. Any questions online, Fabian?
No, no question.
Okay, awesome. So I'll see you all next week. If there any Wednesday, please, any homework outstanding, make sure put that there. I'll put a note so that everyone else sees it and they know that's the last date, and then we go from there. All right. So everyone have a good one. No problem.
Said you give Miss Stan the midterm, right?
Yes, I'm gonna give her the ones who's not here to collect. I'll give her the rest.
Okay.
All right.